Good evening and welcome to tonight's member-only webinar where we look at ASX investment opportunities in review for the 14th of March. The information provided is general advice only. Investor Signals provides a personal investor account service, which is a broking account established in your name. The popular strategy that our clients select is the ASX top 50 stocks, largely followed around our algorithm model. If you'd like to know more about the options available in the personal investor account, please contact me on 1300 614 002. For more information on the products we provide, please visit our website. The research is a subscription service. That'll be the technology that I'm utilising this evening, which is essentially access to our member area. And again, you can find more details by visiting the website. The graph up on screen is the S&P 500. The main point I'd like to make tonight is we're seeing a slowdown in global GDP. And that maybe doesn't come as a great surprise, but to put some numbers on that, the market's now anticipating US GDP to contract from mid-single digits. There was a stage there that it was well above trend at 5 to 6%. What we're now looking at is GDP coming back to around 1.5 to 2%. And if over the course of 2022 we get average GDP maybe somewhere between 2 to 3%, that would be a great outcome, and it would continue to support earnings up at around this 195 to 205 level. So we're probably not likely to see the 220 earnings. And again, if you're joining us for the first time, what that is a reference to is the average earnings of all S&P 500 companies. From a PE standpoint, the market's corrected from about 24 times earnings back to around 19 times earnings. But what that forward earnings number looks like obviously has a big impact on where fair valuation for the market is. It looks to me that the market's a little bit oversold at the moment. We're starting to see some buying activity creep back into the market. And during tonight's recording, the focus will be to identify those names where there's a reasonable margin of safety where you can start taking action by adding new positions into your portfolio. At a bigger picture level throughout the coming months, what we want to watch for is, does the market hold this low that was created on the 24th in the US? In order for the market to rally back up and take out this high, it's unlikely that it's going to be a 2022 earnings story that drives the market back up to take out that high. It probably could be something as simple as, if interest rates don't rise as fast as the market's fearing, we get back into a risk-on technology rallies and we could see a push up to those higher levels. For the moment, for me, the focus is more about the support level for the market and monitoring the buying activity. So in the US, what we're looking for is this low here to hold on the 24th, and we're looking for really the low of last week there on the 8th of March for that to hold in the index, and you want to see this price action back above that 10-day average. Our local market is setting up in a slightly more positive pattern. And what we're looking at is a higher low formation there with support at around that 6,950 points on the XJO. So unless the market reversed back down and took out that low, for the moment the setup's starting to look quite encouraging there on the local market. Before I get into reviewing the opportunities in review, just to recap, clicking on the news button captures access to our daily blog. Now, you'd be receiving an email at 11 a.m. each morning of the articles that are posted on here, but as a reminder, if you've missed that, you come in here, you can scroll down. So I've started to include a bit more commentary now on cryptos. We've included the cryptos in the model portfolio. This is a screenshot of the performance of them, which are delivering some fabulous returns. So if you'd like to know more about some education and mentoring and guidance on what's available, please give me a call in the office and I can talk you through the direction that we're taking with including digital assets in our platform. The US market, so again, this is sort of capturing back on the 12th of the 2nd the highlighting the lower high structure, the market starting to roll over. We bring this forward to the 19th of the 2nd. We're starting to see a continuation of that lower low, lower high pattern, and then we get into the next level of that sell-off, and that's what I was focusing on tonight there, the support off that low on the 24th, resistance there on the S&P, and the need for the market to actually sort of find support, take out that high in the US market. If we look at sort of some of the trends within the US equity market, yes, we've had a correction, maybe something of order of around 10-12% in the S&P, a little more in the Nasdaq, about 20% in the Nasdaq, but still well above pre-pandemic highs. The yield on the 10-year Treasuries is just a reference to interest rates starting to rise in the US. So we've seen the 10-year go from 0.5% up towards 2%, which is where it's sitting at the moment. That's translated into a stronger US dollar. The US dollar's rallied about 10%. Again, just referencing some of these crypto large cap. If you'd like to know more about those, give me a call. Global healthcare, still see that as one of the bright spots in the market, especially from a risk-reward standpoint. Global infrastructure, that's an ETF. Treasury wines, we'll have a closer look at that this evening. Click on the older articles, you can scroll back a little bit further. Goodman Group within the property trust, I'll have a look at that tonight as we toggle through the stocks. Aristocrat Leisure, I think that's getting down to oversold. Wesfarmers is attractive, we'll look at that. Nickel Mines, strong price volatility. This has been impacted by some risks around how the Chinese government respond. Keep an eye on it, maybe down at around this sort of dollar level. Look for buying interest to start to rebuild in nickel mines. So the code for that NIC, I'll continue to update you on that one. Sonic Healthcare, valuation range, think about it from an accumulation perspective. For your investment portfolio, down around that $33 level is a good buy, and I'll spend some time looking at Sonic tonight. Woolworths certainly in buy. Wesfarmers, Telstra, certainly that's back in a range where you want to be taking action and adding Telstra to your portfolio. And there we are, back to last week's webinar. So tonight what I want to do is just focus on the ASX top 50, and in particular really just identify the names that we want to be taking action on, and then I would like to leave enough time to cover off on some exchange traded funds and 2 or 3 stocks that sit outside the top 50 that I'd like to draw your attention to. So the first one in the list tonight is Suncorp. So it's corrected from $13 down to $10, so about a 30% correction in the share price. The insurance environment is obviously tough. This doesn't rate highly on our preferred allocations. It does sit in the model portfolio, but we still maintain that there's an issue for the banking stocks, and Suncorp's more of an insurer than it is a bank, but still broadly these bank stocks have little in the way of revenue growth at the moment, but they are rallying from these oversold levels. So you're seeing Suncorp bounce off that $10 support level there. ANZ likewise rallying off the $25 support level. CBA, I'll just shift that up a little bit higher there. CBA really rallying off that $92 support level. SEEK, later this week we get the Federal Reserve likely to raise interest rates. If they give an outlook statement that suggests that they might be a little more data dependent, given some of the softer forecast for global GDP, the market's going to respond favourably to that, and we may see a rally in tech stocks. So that's one of the themes that we're looking at tonight, is whether we're getting this set up to justify adding some exposure into portfolios in the tech sector. SEEK's one way to do that, and we'll cover off on the other names as I roll through these. Macquarie Group under buy condition support there at around that 175. Computershare, a little expensive, just be patient, wait for that to pull back and switch to an algorithm buy. Horizon, early stages of an uptrend that needs to break through that $3.75 level to confirm a higher low pattern underway. Now these REITs could also be a beneficiary of this interest rate story that I was just talking about. So if interest rates are not going to rise quite as fast as the market's fearing, you could see a rally in the REIT. So Mirvac certainly a consideration there. GPT, Goodman Group, or the SLF, which is the ETF that replaces these REITs. But Mirvac should be getting close down to support at around $2.50. ASX, the correction from 95 down to 80, that's attractive, and you can think about adding that into your portfolio. Stockland bumping sideways. Aristocrat, the correction from 50 down to 35, should rally if we get this set up in the tech stocks like I'm thinking. Goodman Group under buy conditions, back on support, they're at around $21. You want to think about adding that in your portfolio. Likewise, James Hardie, the correction there from 57 down to $44, $45. That's starting to offer value. Treasury Wines, I expect that to develop an uptrend throughout the course of this year. We're looking for it to take out that $12 high and start to build on that higher high, higher low pattern. Ramsay Healthcare, the correction from 75 down to 61. Good value, add a small amount of that into your portfolio, support that around that $60 level. Telstra, the correction that we've had here from around $4.30 down to $3.90, the company's still likely to deliver 5 to maybe 8% earnings growth. The dividend yield's attractive, so buying that on the dip, I'd encourage that. NAB, under buy conditions, an alternative to the banks is the MVB, which is an ETF that captures all the banks. But NAB in the process of making higher highs and higher lows. There's Sonic Healthcare. So if you haven't added this into your portfolio, you can see the range there. It's a fairly wide band. I think you need to start accumulating some at the top of this support line and keep some firepower in reserve to add to it if for any reason we get a softer market. I don't expect it to get down to the bottom end of that band. I think we're pretty close here to where buying interest starts to pick up. And just as a reminder, Sonic has got a $500 million share buyback that the company will be doing over the next 12 months. And the company's only just started that process about, I think, 2 days or 3 days ago. Qantas under algorithm buy conditions, support that around $4.50. Dexus under buy conditions. The industrial portfolios of Dexus, GPT and Goodman Group are highly attractive, and I think they continue to drive above average earnings growth. So it could be providing the interest rates don't shoot up too high in the US, we could see further upside for these REITs in Australia. Wesfarmers, the correction from 65 down to 49 makes it attractive. I've created a band there where for investors you just simply want to think about accumulating it within that range. Adding some exposure on the top of that support level there is sensible. Brambles, okay with this from a valuation. Now, you're not going to make the position size here in Brambles quite as big as what you would do with the exposure to Telstra. We are seeing growth slow in Brambles from an expectation of about a 6 to 8% earnings growth to probably something more like 3 to 4% earnings growth. But around this $9, $9.50 level should start to find support and build support. Find support and build higher levels. Woolworths under algorithm buy conditions. I think the low's in place here. I'd be surprised to see it take out that recent low there of $33.50. Should start to see Woolworths grind higher. And my target for Woolworths is probably really just back at around that $37, $38 level. Xero, this is getting oversold. Could be a great opportunity coming into the latter part of this week. Look for the price action to get back above that 10-day average. And a good trade setup should start to develop there, and I'll focus on that one on the daily blog as we get into the latter part of the week and we understand what's happening in those US interest rate pictures. GPT, the correction from 550 down to 480, that starts to look attractive. APA bumping sideways, but we are in an environment where we're likely to see better earnings growth from APA and analysts upgrading their price targets on APA. Lendlease, even in a soft market, if you think about the selling that's taken place broadly in equity markets over the last month or two, Lendlease has actually held up quite well. Now, the company's guided towards a better outlook over the next 12 months. We want to see the price action take out that $11 high. And what we're looking for is the beginning of a multi-year recovery in Lendlease. But still, tricky environment globally at the moment. But Lendlease looks to be an area that maybe institutional money is increasing their exposure to Lendlease, given how well it's held up in a soft market, and I think that's sort of feeds into that view that maybe over the next 12 to 24 months you see a recovery there in Lendlease. Tabcorp bumping sideways, ResMed under buy conditions, we like that, spent a bit of time talking about that in prior weeks. Origin Energy, getting a little mature, the rally maybe in the energy names, so if you're either thinking about locking in the profits from entering the trades last year, or maybe just being patient waiting for a pullback in the next algorithm buy signal. You can see there the algorithm buy and Origin's rallied. And I suspect Origin's probably in the beginning of a multi-year high, low formation, as is Woodside Petroleum. So the next pullback that you see in Woodside and an algorithm buy signal will certainly be drawing that to your attention. The same with South 32. This commodity market may have just ran a little hot at the moment and we see a bit of profit taking, but you still want to be willing to buy the dips in that commodity story. Scentre Group, not too much in the way of strong earnings support there, so not doing too much there at the moment. Insurance Australia. So now what we've done is shift to stocks that are under sell conditions, and just to move through a couple of these. CSL under sell, Westpac under sell, QBE, Coles, Cochlear, Amcor, Transurban, Santos likely to shift to buy conditions over the coming months. I'll keep an eye on that. Rio, so these large commodity stocks, we're seeing them now under sell conditions, so both Rio and BHP. Fortescue under sell. Newcrest, probably like to see Newcrest shift to buy conditions later in the year. And there we are. So I've just gone through the top 50. Now what I want to do is just go back and just highlight some individual stocks that you've hopefully made a note of. So just going through these, Wesfarmers, there's an opportunity to think about this in portfolios down here at around $49. Telstra, we touched on this, but Telstra at around $3.90. You want to be thinking about having exposure to that. Sonic Healthcare, I really like this. I think you're almost getting free exposure to the underlying business of Sonic, still growing at a mid-single digit rate, so I'd be really surprised. The analysts are quite negative on this at the moment, just simply because of the falling earnings from the COVID-related testing income, starting to wind down. But the underlying business is still attractive, so there's an inflection point coming where Sonic rallies. Whether it gets down to the sort of the middle of that band at $30, I don't know. I suspect we're pretty close now to where institutional buying picks up. But also the company's doing a $500 million share buyback, so you're going to have them in the market as well, providing some support. Goodman Group, the correction that we've had in Goodman Group from 27 back to 21 puts that back on the radar. You want to think about adding that to your portfolio. One that I didn't cover in the top 50, but Star Entertainment. Much higher risk proposition here, but they're coming from a very, very low base of troubled earnings period over the last 24 months. Does the next year or 2 years start to improve for Star Entertainment? I suspect the answer is it likely does. So how you want to approach this, you could keep your position size small and build on it as the uptrend develops and you get subsequent algorithm buy signals, or you could simply run a stop loss below the recent low there, which would be a low of 318. But what I'm mainly drawing your attention to is the shift from sell conditions into buy, and an expectation that you could see a scenario where international travel to some extent starts to resume. People become less homebound, and we start to see an improvement in earnings for Star Entertainment. So just start to have a think about how you see that sitting in your overall portfolio. Aristocrat Leisure, like this name, and I've commented a few times this on the blog. If you're a trader, what you might want to do is just watch the price activity, make sure it sits above that average, and we could start to see a rally, and that might be one of those tech stocks that benefits if we see a situation where the Federal Reserve suggests that they're a little more data dependent given some of the recent events at a macro level globally. Fisher Paykel Health, coming from a high PE valuation, but again, keep an eye on this one, see whether it can trade back above that moving average. I think from a longer term fundamental standpoint, you're getting down to a range where there's value on offer and you could look to accumulate the stock within that band that I've indicated on screen there. But even as a short term trader, you may even just watch for a close above the average and be willing to consider a trade in that based on the momentum staying above that average. Okay, couple of other stocks and then on to the Etf Pexer Group. I like this. The correction that we've seen from 20 back down to $16 puts this back in a buy range. It's under algorithm buy conditions. It is a tech stock, so what I'm thinking is we get a rally over the next few weeks, month, trade back out of it. Pro Medicus, continue to like this in the medical space. It is expensive. It is expensive, sitting on support there at around that 40 to 43, but again, if we get this set up where the market moves back to a risk on week, later this week, you could see Pro Medicus being a beneficiary of money coming back into the higher PE, higher growth tech themes. So keep an eye on that one to trade above the 10-day average, and I'll focus on that on the blog. Now, just to finish this evening, let's just go through some of the ETFs that I've got on my notepad. So the Banks ETF is the global equivalent. Locally, we have the MVB, which picks up a fund that gives you exposure to all the domestic banks. This one gives you exposure to the global banks. It's under algorithm buy signals, and we've had the correction from 750 down to around 625. And really just drawing your attention to that. Healthcare, I think, is a much lower risk proposition, and this particular ETF, the VanEck Vector Global Healthcare Leaders, is down at a range where I think you can safely accumulate and build exposure to that. Now, picking up on some of this global recovery theme, and there's a number of different ways to play it. But the Quality Global Growth Fund, the correction here from $9 down to $7, that's now on my radar. Slightly higher risk and fits in a bit more with this tech recovery play that may eventuate towards the end of the week, so we're watching out for that. But the BetaShare Global Robotics and Artificial Intelligence ETF, so support down there at around that 1120. Watch for that to cross above the average, and I'll certainly keep you updated on the blog regarding that trade. In cybersecurity, I think this is an interesting growth opportunity over the multiple years. The correction that we've seen from 12 down to sort of 9, now the recovery up to around 990. That is something, so we hold that in our portfolios. IAA, now this is a really interesting part of what's going on in the market at the moment, is the selling pressure in Asian stocks, in particular Chinese related stocks. Now, if you thought that the global division and delisting of companies and isolation of economies was really going to get worse, then you may not share my optimism for a recovery here in these Asian stocks, but it's one of the areas of the market where I see deep discounts, and you have to think back to periods in the market where sometimes the fundamentals or the news flow looks terrible, sounds terrible, is terrible, but a recovery gets underway well before the good news starts flowing. And that may very well be the case, I think, in these exposure. What you're trying to do is to get exposure to the best quality, diversified portfolio of Asian stocks. The IAA is one way of doing that. The IZZ is more specific, obviously, to China. But IAA, it's a fund that's managed by BlackRock, largest asset manager in the world. and it's diversified, not just China based. So I continue to like that. Couple of others just to finish on. DVDY domestically, this is the Van Eck Vector Morningstar Australian Moat. Again, I'll revisit that on the blog. I think that's probably down at support here at around $20. And then finally, let's finish with the SLF, which is that Real Estate Investment Trust, which is the Spider ASX 200 listed property fund. Likely down on support here at around $13, and that's a buying opportunity. And to rattle off the individual stocks, Goodman Group, GPT and Dexus rate highly out of the REITs, and we'll be watching these interest rate pictures in the US later this week, thinking that we may get some sort of recovery in some of these yield sensitive names. So think about stocks such as Xero and Aristocrat as ways of playing that. But from an overweight position, the focus is still healthcare over financials as a way of sort of having a larger risk margin with attractive upside in some of those healthcare names. So again, if you'd like to know more about the strategies that we're implementing across client portfolios, please give me a call on 1300 614 002.